Do you want to understand the mysterious option Greeks, better known as Delta, Gamma, Theta, Vega and Rho? In this video, I will explain to you in a simple way how they can be your secret weapons in options trading to maximize profits and manage risk. Like the Greek gods, the options gods oversee certain areas, including price, time, and implied volatility. The Greeks are an essential part of options trading because they tell you how changes in certain factors can affect the price of an option. So let's get to know them. Let's start with Delta. Delta is the ruler of all the other option Greeks because it often has the biggest impact on an option's value. The option delta was one of the main factors why my channel is called Deltatrading and not alpha, beta trading, or something else. By the way, if you found value in this video and want to accelerate your path to trading success, subscribe to my channel and hit the like button. It means the world to me. Delta's domain is price. It indicates how much the option premium can change if the underlying price changes by $1. This means that an option with a delta of 0.40 would be expected to increase by 40 cents if the underlying asset increased by $1. Delta has another important use. Some traders use it to estimate the probability that an option will expire in the money. For example, an option with a delta of 0.40 can be interpreted as having a 40% chance of expiring in the money. The lower the delta, the lower the probability that the option will expire in the money. One important thing to note about delta is that it doesn't have a constant rate of change. It grows as an option moves further into the money and shrinks as it moves further out of the money. To understand how this works, let's look at the next Greek, Gamma. Gamma is delta's right hand in the price domain. Gamma measures the expected rate of change of delta. If an option has a delta of 0.40 and a gamma of 0.05, we expect the premium to change by 40 cents with the first dollar move in the underlying. Then, to figure out the impact of the next dollar move, we simply add the delta and gamma together to find the new delta, 0.45. Let's move on to Theta, the Greek for time decay. Theta estimates how much value an option will lose each day. If an option has a theta of negative 0.04, it would be expected to lose 4 cents in value each day. Remember that time decay works against buyers and for sellers. Finally, there is Vega, whose domain is implied volatility. Vega estimates how much the premium is likely to change for each percentage point change in implied volatility. If an option has a Vega of 0.03 and implied volatility decreases by 1 percentage point, the premium is expected to decrease by 3 cents. There are many factors that can cause a spike in implied volatility: earnings announcements, political conditions, and even the weather. Depending on your strategy, a spike in volatility could be a blessing, a curse, or have very little impact. And the further out an option's expiration, the higher its Vega will be. In other words, options with longer expirations may be more sensitive to a change in volatility. Now let's talk about the little brother of the option Greeks, Rho. Rho measures how much an option premium can move when interest rates change. Because interest rates change slowly, they have less of an impact on options trading. Like all little siblings, however, Rho is often left out of the discussion of the Greeks. However, Rho is still part of the family, so it's worth mentioning here. Now, let's gather our Greek counsels and see how they can be used to analyze the sensitivities of a single option. To set the stage, let's say your option premium is $1.30, and your option has a delta of 0.35, a gamma of 0.06, a theta of 0.02, and a vega of 0.07. Today, the price moves from $45 to $46, and the premium increases by 35 cents to $1.65. Since 1 day has passed, the premium decreases by 2 cents due to Theta. Tomorrow, the price moves from $46 to $47. The premium increases by 41 cents to $2.04. This is delta plus gamma. Also, another day gone means another day of time decay and another 2 cents down the drain. Implied volatility rises by 1 percentage point, increasing the premium by 7 cents to $2.09. Putting all these factors together shows how a relatively small change in the underlying can lead to a fairly significant change in the option premium. All of the option Greeks are essential to know in order to be a profitable trader. They will help you understand the impact that various factors can have on options trading. Thanks for watching. If you found value in this video and want to accelerate your path to trading success, subscribe and hit that like button to get more videos like that. You want me to cover a specific topic or have a question? Let me know in the comments below.